This video is going to cover the key control systems or cycles. It has been prepared to help you understand the stages of the key control systems and their objectives, the risks within the systems, and the controls that will help reduce the risk of the problems occurring. The control cycles we are going to cover are the systems linked to the financial statements. They have an impact on whether the financial statements are true and fair and are the sales, purchases, assets, inventory, payroll and cash systems. For each system, I will outline the stages of the system and examples of the objectives, risks and controls at each stage. We're going to start with the sales system. It has 5 key stages where controls should be designed to ensure mistakes do not happen. Stage 1 is when the order is received. Stage 2 is when the goods are dispatched. Stage 3 is when the invoice is sent. Stage 4 is when the transaction is recorded in the financial statements. And Stage 5 is when the cash is received. Stage 1, when the order is received, is usually in the sales department. It could be taken over the phone, via a website or by email. A sales order should be produced for each order received. The objective of controls at this stage is that all orders are processed and customer orders are only accepted for customers who can pay. An example of risks are an order is taken for a customer who has exceeded their credit limit or the order is not recorded properly. Controls to be put in place could be access to the customer account where the credit limit can be reviewed when the order is taken. Stage 2, when the goods are dispatched, is usually in the warehouse. A delivery note or goods dispatch note should be produced. The objective of this stage would be for goods dispatched to be on time to the correct customer and all sent out. An example of a risk is that goods sent out are for the wrong quantity. Controls put in place could be the dispatch team must agree the original order to the dispatch note and the goods to indicate with a signature that this has been checked. Stage 3, when the invoice is prepared and sent, would occur in the accounts department. The objective would be all goods have been invoiced for and all are invoiced with the correct amounts. An example of a risk is a customer was not invoiced with the right product, and controls put in place could be a copy of each dispatch note is sent to the accounts department sequentially numbered. The accounts team should review the dispatch note when preparing the invoice. Stage 4, when the transaction is recorded, would also be in the accounts department. The objectives would be to include all invoices on the system for the correct amounts. A risk would be that sales are not recorded accurately or in the correct period. And a control would be to prepare invoices with sequential numbering. On entering the invoice to use that reference and regularly check the system to ensure the sequence is not missing an invoice number. Stage 5 is the payment from the customer. The objective is to ensure cash is received on a timely basis and recorded correctly in the correct customer account. A risk could be that the cash is not paid on time, and a control would be to having a member of staff perform credit control procedures such as reviewing the sales account regularly for debts that have reached their payment deadline and chase customers for payments. The purchase cycle has 6 stages where controls should be in place to reduce the risk of fraud and error. Stage 1 is the requisition stage. Stage 2 is where the order is placed. Stage 3 is where the goods are received. Stage 4 is where the invoice is received from the supplier. And Stage 5 is where the invoice is recorded on the account system. Stage 6 is where the payment is sent to the supplier. Stage 1, the requisition stage, is where the business or division within the business will recognise the need for more goods. A requisition note will be passed to the purchasing department detailing the supplies needed. The objective is to ensure goods are requested and are for business purposes. A risk could be the requisition note may not be received by the purchasing department and the order not made. A control could be requisitions are made by email to the purchasing department, who must respond when they have made the order. Stage 2, the ordering stage, takes place in the purchasing department. There should be a purchase order for each order made, which details the goods ordered, the quantity, price and supplier used. The objective is to ensure suppliers used have been checked for reliability, quality and price, and orders made considering disruptions to production if not delivered on time. A risk could be a supplier is used who is not reliable and delivers late, leading to a delay in production. A control could be to select a supplier from an authorised supplier list. This list could be authorised by senior officials and regularly reviewed to ensure suppliers' quality and price have not changed. Stage 3 is when the goods are received. This is usually in the warehouse, where a delivery note or goods received note will be prepared. The objective is to ensure only goods ordered are received and accepted and received on time. A risk could be that goods received have not been ordered by the company, and a control would be for every delivery the goods should be inspected and agreed to the delivery note and a copy of the purchase order. This should then be signed by that staff member. Stage 4 is when the invoice is received. This will be in the accounts department. The objective is to ensure invoices received are for goods received. That is for business purposes and for the correct amounts and products. A risk could be that the invoice is not for goods ordered, and a control would be each invoice received should be matched with the corresponding purchase order and requisition note. Any that have missing orders should be investigated with the supplier. Stage 5 is the recording of the invoice on the accounting system. The objective is to ensure all invoices are recorded and they are recorded accurately and in the correct period. A risk is that invoices may be missed and payables and purchases understated. A control could be ensure each invoice when received is allocated a sequential invoice number. The sequence should be checked regularly on the system to ensure no invoices have been missed. Stage 6 is the payment to the supplier. The objective is to ensure payments are made for the correct amounts, for goods ordered and received, and made on time. A risk could be the payment is not made and the supplier may no longer grant credit. A control could be to have regular payment runs and to review the aged payables list regularly for older debts and ensure they are paid on time. The control system for assets would work in the same way as the purchase system. There would be some additional controls required due to the size of the values being spent on these items in comparison to the standard goods and services. One would be the authorisation of costs. This would need to be approved from a much senior level of management than your standard purchase. The other would be the use of the asset register. This spreadsheet will record all details in relation to the assets in the business, including the date, cost, depreciation, carrying value, location, and disposal date and proceeds. This should be updated and reviewed regularly and compared to the accounting system to ensure there are no errors. The inventory cycle works very much like a cycle. The business will make an order for inventory. The inventory will be received in the warehouse. Sales will be made. The inventory will then be dispatched to the customers. So more goods will be needed and they can make an order for more inventory. We have seen many of the controls already in this process as the inventory cycle is blended with the sales and purchase cycles. Looking more specifically at other inventory controls, what we haven't yet seen are storage controls for inventory, and controls over monitoring the amount of inventory in the warehouse, or inventory counting. When the business is storing its inventory, the key objective is to keep it safe and maintain its value. The risks are goods could be stolen, goods could be damaged, and goods may become obsolete. Examples of controls to reduce the risk of theft are increased security such as CCTV, alarm systems and security guards, restricted access to the warehouse, for example limited exits, and only authorised access, for example swipe card access or fingerprint recognition at entry points. Examples of controls to reduce the risk of damage could be practical packaging of inventory items, shelving for organised storage, and training for handling of items. And examples of controls to reduce the risk of obsolescence are a first in first out system for items being dispatched, not to hold excessive amounts of inventory, regular monitoring of aged inventory list for old slow moving items, and special offers potentially to shift items that are not selling faster. The inventory counting process requires tight controls for it to be effective. The external auditor will always review this control carefully, as if there are deficiencies, it could lead to material misstatements in the inventory balance. This would affect the statement of financial position and the P&L. If the company carries out a year-end inventory count, the auditor will attend. If they carry out several counts during the year as a continuous counting process, the auditor will attend a sample. There are elements of the count that are important to have controls. These are the people counting, the admin or paperwork, the count itself, and the end process of the count. The people counting the inventory should be objective. They will be staff members but should not be the warehouse staff. This reduces the risk of theft being hidden by those who are in a position to steal. The counting should be carried out in teams of 2 or more, and the process should be supervised by someone senior, for example the internal audit manager. There are 2 key pieces of paperwork, the count instructions and the count sheets. The count instructions should be clear and easy to follow. They should be given out before the count, and the staff should be briefed so they fully understand what they are to do. The count sheets should be sequentially numbered. Spare sheets for inventory found not on them should also be pre-numbered, so sheets cannot go missing. These sheets should include the product details such as the description and code, but should not include the quantities as per the system. This stops count teams just agreeing with the number. During the count sheets should be divided between the teams. The sheets should be signed out so they know who is counting which area. Count staff should inspect inventory for evidence of damage which could affect the valuation and flag this on the count sheets or to the count supervisor. There should be a systematic, organised count to reduce the risk of areas being missed or counted twice. Areas can also be marked once counted to reduce the risk of mistakes. When recording the quantities on the count sheets, they should mark in pen and not pencil. This will identify if any changes are made after the count. At the end of the count, the sheets should all be signed back in and the sequence checked to ensure no inventory sheets are missing. These are then used to calculate the valuation of inventory to include in the financial statements. External auditors would take a copy of the count sheets as evidence before they leave if attending. The payroll cycle identifies important stages where controls should be present. Stage 1 is where fixed and variable data regarding the employees is recorded on the payroll system. Stage 2 is where the calculations are made by the system. Stage 3 is where the outputs from the system are created, such as the payroll report and the payslips. Stage 4 is where the payments are made to the employees and the government. Fixed data regarding employees includes bank accounts, hourly pay, holiday days, etc. Variable data would come from the clock cards or timesheets in the form of hours worked to help calculate pay. This data needs to be kept secure, so locking away this paperwork and only allowing authorised access is important. The other risk is that information is open to manipulation, for example including fraudulent working hours. Controls to reduce this risk include CCTV over the clock card area as a deterrent, authorisation of overtime from a senior official, and supervision of employees. The calculations made by the payroll system must be monitored regularly as there is a risk of misstatements. The software used should be up to date and regularly checked for updates. Having updates via the internet reduces the risk of these being missed, for example. Also, regular checks on calculations. Taking samples and recalculating the pay and deductions would identify if the system is working properly. The system itself should also be secure. Ensuring only authorised access is permitted will avoid the risk of individuals changing pay or setting up fake employees. Therefore, secure password access is important. The payroll report and the payslip should only be accessed by those authorised to see them. Therefore, locking payroll reports away is a good control, and sending payslips straight to employees' home addresses would avoid this information getting into the wrong hands. The payroll report should be reviewed by the payroll manager. Comparing to previous months, the previous year, and budgets will identify if something looks unusual. Evidence that this has been carried out, such as a signature and date, would enforce the control. Finally, stage 4 is the payments. Payments to employees and the government must be made on time. Therefore, setting deadlines for submissions such as overtime should be in place. The correct amounts must be paid and only to valid employees. Therefore, having a senior official, such as the payroll manager, review this information from the payroll report and the payment sheets will reduce the risk of an incorrect payment. Cash controls are our final system to review in this video. The stages of a cash cycle are: Stage 1, a payment for an item is requested. Stage 2, the payment is authorised. Stage 3, the payment is made and receipts come in. Stage 4, all movement in cash is then recorded in the books and records. The objective for controls over cash are: to ensure cash is kept to a minimum at the company premises. Payments and transfers can only be made with authorisation from a senior official. They are for business purposes only. Cash is protected from theft and banked regularly. An example of some controls to achieve the objectives include: using an impressed system for petty cash, having a manager's signature for all payments made, regular review of the cash book and petty cash book by management, locking away cash in a safe at the premises, and regular banking patterns using different staff, taking different routes to the bank to avoid theft. We have now reviewed the key control systems that connect to the financial statements of an organisation. For each system, a good understanding is needed of the objectives, risks, and effective controls that a company should have in place. The specific controls within a control system will reduce the risk of fraud and error. They will not eliminate the risk, as controls have limitations, as we have discussed in another video. The stronger these control systems are, the less chance of material misstatements being present. This in turn assists the external auditor. Audit risk will be reduced, making it more straightforward to form their audit opinion. I hope you found this video useful. Thank you for watching.